Welcome back to another explosive episode of Boss Economics World. Here, we dive deep into the economic train wrecks governments don't want you to see and expose the policies that are driving economies down the drain. And boy, do we have a lot to talk about today. Let me set the stage for you. It's the start of 2025, and guess what? UK food prices are now climbing at their fastest pace in 9 months. Yes, folks, that's a staggering rise headlined by, of all things, chocolate and alcohol. Retailers are warning consumers to brace themselves as inflation is knocking on the door once again. You wanted a Kinder 2025? Think again. But let's unpack this a bit. First, food prices in January rose by 0.5% over just a single month. And while that may seem small, you better believe this is enough to send economists and everyday shoppers into a frenzy. Worse still, food prices are currently 1.6% higher than they were just a year ago. Let me translate that: your morning cup of coffee, your weekly grocery run, all of that is steadily getting pricier. So, buckle up because this is just the beginning. The Bank of England, BO, is facing one hell of a challenge as its major meeting looms next week. The question is, what do they do now, amidst a cocktail of climbing food prices, sticky wage hikes, and tax hikes thrown in by Labour's latest budget blunder? Do they raise interest rates? Cut them? Or simply wave the white flag and admit they've lost control? Now, let's not simply gape at the surface-level crises. We need to dig deeper into the messy underbelly of Britain's economic troubles, because trust me, there's more to this than just a rise in food prices. You've got major Brexit fallout, world energy market shocks, wage policies gone haywire, and that deadly budget from Labour that's pouring gasoline on the flames. You probably noticed that your energy bills have been looking a little, well, monstrous lately. Energy prices are shooting up globally, thanks to shielding tariffs disappearing, geopolitical conflicts, and shrinking energy supplies. Higher energy costs smack the economy in two places: they raise the cost of living for households and drive up overhead costs for businesses. But how does this connect to food prices? Well, food production is energy intensive. Think about it, from powering the tractors harvesting your corn to running the machinery in food processing and storage. When energy prices rise, so do the costs for producing, storing, and transporting food. Layer that with upward pressure from wages, and it's not hard to see why your supermarket basket is costing more than you remember. Let's zoom in on that absolute monstrosity of a policy everyone should be talking about: the £26 billion payroll tax hike and yet another large hike in the minimum wage. Yes, folks, the government thought the best way to boost an already struggling economy was to slap businesses with extra employment costs. Let's be clear, in theory, tax hikes and wage hikes can make sense if you're balancing a stable, growing economy or if there's room in the fiscal space for businesses to absorb these shocks. But in the UK's current environment, where businesses are teetering on the edge thanks to energy costs, Brexit effects, and pandemic-induced corporate debt, this move is like handing a drowning man a backpack full of stones. This is all leading to a ripple effect. 53% of businesses recently surveyed by the BO said they'd have to start raising prices to account for these budget changes. When businesses face higher costs, what do? They either cut jobs, reduce workers' hours, delay investments, or hike up prices for the consumer. Basically, the people at the checkout line pay the price, again. Take grocery giant Sainsbury plc, for instance. They've just announced major job cuts to the tune of 3,000 employees. Why the cuts? Simple: higher labor costs are forcing them to push employees out to stay profitable. Job insecurity is increasing, which will bleed into consumer sentiment and dent consumer spending. This is an economy-wide feedback loop waiting to explode. Let's call it what it is: this government-induced inflationary pressure, layered with job cuts and weakened business confidence, is a fast track to stagflation. Brief history lesson: the last time the UK had a bout of stagflation this severe was in the 1970s. We're talking insane inflation and economic stagnation, a situation where prices keep going up but businesses stop growing and start shedding jobs. The difference now is there's no booming oil market to help us out, just tightening global energy supplies and shaky trade relations due to Brexit. All eyes are on the BO's February 6 meeting as they try to figure out this delicate balancing act. Conventional wisdom would have seen interest rates come down, right? After all, the economy's starting to slow down, and lower interest rates could provide firms with the flexibility they need to borrow and invest. Investors are still betting on a quarter-point cut next week, one of the two small cuts they're forecasting for the year. But hold on a minute, the inflation bomb is ticking. When inflation's on the rise, dropping rates is playing with fire because it'll pour more fuel onto the price hikes. With January's food prices already exploding and wage push factors building up, the BO's hands are tied. Cut rates, and you risk sparking even more inflation. But if you don't cut rates, you could risk pushing the economy deeper into recession. This is the tightrope walk central bankers detest: choose between the lesser of two evils. Retailers are in a similarly impossible position. Fierce January price cuts, 0.7% decrease in overall retail prices, helped stave off some inflation in non-food sectors. You can thank post-Christmas sale markdowns for that. But retailers aren't going to be able to keep these price cuts up for long. What happens when their margins start feeling the pinch of these £7 billion worth of new regulatory and wage costs dumped on their backs? One thing you can bet on is that price cuts and deflation in some sectors won't last. Retailers aren't a charity. They'll pass these costs right on to the consumer once the discount season fades. Helen Dickinson, the chief executive at the British Retail Consortium, nailed it when she said, "The full impact of the latest budget doesn't hit retailers until a few months from now, and when it does, we'll see price inflation again, and worse than ever." Guess who's absorbing that? You, the everyday consumer. Behind this dramatic rise in food prices, these macroeconomic pressures start pulling the curtain back on the bigger story. Consumers aren't just paying more at the store. They're also facing energy bill hikes while the job market tightens and wages stagnate relative to costs. Small and medium-sized businesses, the backbone of any economy, not just the UK's, will feel the squeeze hardest. Unlike larger corporations, they don't have the kind of buffer to absorb these regulatory and fiscal overheads. Expect more layoffs, more shop closures, and less investment to hit innovation and productivity. The national mood is souring. When people lose jobs and prices keep rising, pessimism takes hold. Consumer confidence plunges. This becomes self-reinforcing, deterring spending and pushing the UK economy to stagnate further. Here's the kicker, folks, and this is why tonight's show is a grenade lobbed at the people in Westminster. Prior warnings were ignored. These conditions didn't arise in a vacuum. The Bow has consistently voiced concerns about rising inflationary risks from the government's aggressive policies, and leading economists had already pointed to the perils of making radical fiscal moves in the current environment. It doesn't take a genius to see that poor government planning put British businesses and households in this bind. Brexit was badly handled. We've been caught in trade hell ever since the UK left the European Union. The energy market is in freefall, with regulators too reactive instead of leading on lowering energy dependencies. The Labour budget aimed to appease short-term political goals at the expense of long-term economic stability. And the very same people who implemented these policies are now banking on the central bank coming to their rescue with cuts. Absolutely irresponsible. Now that I've illustrated this sprawling mess, it's only natural to ask, where do we go next? Truth be told, we're sitting on the edge of major economic turbulence. Stagflation, mass layoffs, price hikes, and eroding market confidence. 2025 started gloomy, and unless the people in charge radically alter course, it's going to end in wreckage. The Bow's options are painfully limited, and the government needs to get serious about fixing the structural damage it's caused. But worst of all, you, the working individuals and concerned citizens, are the ones who will feel this pounding every time you pay your bills or walk into a supermarket. So hang in there, Britain. The economic storm is just beginning. Let's hope the policymakers buckle up, or this ship is sinking.